Bloomberg Audio Studios. Podcasts, radio, news. This is the Bloomberg Surveillance Podcast. Catch us live weekdays at 7 a.m. Eastern on Apple CarPlay or Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Victoria Fernandez, Jordan Rochester, Michael McKee, Francis Donald, Ian Lyngen. We go into this inflation report strong with Neil Dutta of Renaissance Macro. Neil, you're more cautious now on real GDP, on the growth of the nation. All the inflation numbers pretty much on the survey, but I really want to focus out on real personal spending, declined way off survey, and personal income with a nice lift as well. I got retail inventories, which I don't understand. We're going to skip that. I got a little bit of an equity lift. I went right to the 10-year real yield, came in a little bit, but it comes right back. Neil Dutta, am I right that this was a nothing burger?
I mean, real personal consumption fell quite a bit to start the quarter. Yeah. That's probably going to put downward pressure on tracking estimates of first quarter GDP, and will probably prompt some marking to market of forecasts among the consensus. So I don't.
Right.
Is it a nothing burger? I mean, I think the inflation numbers came in line with expectations, but real GDP is probably getting worse.
This is critical, folks, with real spending. I mean, what we see on the ECO screen of the Bloomberg, real personal spending came in light. Personal spending itself came in light. A little bit of a constructive revision. But, Neil, it's unfair to ask this, but it's unfair Friday. I mean, can you model out sub 2% GDP looking at 2 quarters of data to the 4th of July?
Yes, I think that's possible. I mean, look, most of the upside surprise in GDP growth last year was in 2 areas: consumption and government spending and investment. That's what drove most of the growth. So if you think those 2 areas are going to slow, it doesn't really take much. At the same time, you layer on the fact that residential construction is likely to get worse, not better. Export activity was a big driver for growth last year. I mean, if this trade stuff keeps up, I mean, there may be some risk to exports as well. So I don't think it's that much of a stretch. I mean, you're talking about a 0.5% monthly contraction in real consumer spending. I mean, these tracking estimates might be at 1% for the quarter after today.
Yeah, that's kind of where I wanted to go, Neil, because this amateur economist here, that's the number that kind of jumps out at me, and I'll just highlight it for the audience. Real personal spending, the consensus was for a decline of 0.1%, came in at a decline of 0.5%, so missed there. And you compare it to last period where it was revised higher to positive 0.5%. So a big delta there. I do know that, you economists tell me that the consumer is 70% of the economy. So that really does get your attention. Is that a number that moves around a lot?
Consumer spending tends to be, more stable. I mean, a lot of acyclical areas of consumption, right? I mean, so people have to go out and kind of spend. But ultimately, generally speaking, consumption follows income growth. And, what you can basically say is that, in January, I mean, there was an increase in precautionary saving, maybe. I mean, that's basically what it that income grows. But again, that goes totally against what people are sort of worried about right now, which is inflation expectations, right? I mean, that's allegedly the reason why the Fed is holding off. Everyone's pointing to you, Mish. Now, guys, think about what inflation expectations should mean. It should mean, number one, people are going to bid up their wages because we know that wage growth is set with short-run inflation expectations in mind. I mean, I don't know. Good luck to any worker that's going to try that right now. I mean, you're in for a rude awakening. But more importantly, it's you try to spend more to beat the higher prices later. There's no evidence that that's happening. You're seeing precautionary saving, not precautionary spending. So this notion that inflation expectations are rising and this is why the Fed needs to hold off.
Ian,
Sorry, don't buy.
Neil, I want to get one more question in here. I think it's so important. Ian Lingen's being patient to wait for us. Neil Dutta, is there a wealth effect of the fancy people in the personal income, personal spending? Do you see the stock market? Do you see the way Paul Sweeney made money on NVIDIA? Is that in those statistics this morning?
Well, I mean, there was a great article from the Wall Street Journal about a week ago, I believe, about just talking about how consumption is being driven increasingly by the high end. And so, obviously that's affected by what's going on with asset prices. But what I know about asset prices is that, stocks are not making new highs. They haven't been. Number two, a lot of these sort of alternative assets like crypto have come under pressure. And more importantly for everyone else, home prices are moderating because inventories are jumping. So, to the extent that the wealth effect was an important driver of consumer spending, that's looking a little bit shaky now as well.
Neil, thank you so much. Neil Dutta with Renmac, just brilliant there as we looked at PCE and as Paul Sweeney mentioned, real consumer spending, real personal spending with a shock, a little bit negative, maybe new GDP markdowns. And we'll get to the bond market in a moment here with Ian Lyngen. Our economic indicators, what we do each and every day, but particularly on these important key days. It's brought to you by IBKR. Will the year-over-year change in the U.S. business inflation, U.S. PPI, will it exceed 3% in February of 2025? At IBKR Forecast Trader, the yes was recently at 39%. What's your take? Trade your prediction at ibkr.com/forecast. We welcome all of you on YouTube nationwide. Again, go to YouTube, Bloomberg Podcast, subscribe there. Growing each and every day, 7 days a week, grows on a weekend.
Sure, yeah.
Is well. Joining us now, BMO Capital Markets, Ian Lyngen. Ian, I'm looking at lower yields. Neil Dutta has given me lower GDP. Do we finally have in place the vaunted Lyngen vector where we get shockingly lower trends in yield?
Well, I do think that we're overdue for a continued drift lower in rates. I wouldn't be very surprised to see the current move get 10-year yields a lot closer to 4%.
So
that gets your attention.
So how do you think the Fed, Ian, is going to look at some of this data today as they try to get a gauge on their balance between the labor market and prices?
Well, I think that core PCE was in line with expectations. I think that to a large extent, the inflation profile is known. What's unknown is what's going on in Washington. How does that lead through to sentiment in the employment market? And that jobless claims figures from yesterday were a bit troubling. We're at 242. It's the highest since early December.
So again, that kind of suggests that it feels like the Federal Reserve's just like the rest of us. They're just kind of looking down to Washington, D.C., trying to stay on top of all the news flow coming out here. How long can they sit on the sidelines, do you think, Ian?
Well, I think that the Fed can avoid cutting rates again, at least through the first two quarters. I think it's very reasonable to assume that they skip the next few meetings. The first rate cut maybe comes in September, but there's a lot of uncertainty between now and then. The only way that things are going to shift dramatically is if we see a further correction in the equity market that tightens financial conditions or an increase in the unemployment rate, both of which are possible.
We're going to have to do an audible here. We're going to come back to interest rates with Ian Lyngen. Ian, Canada just reported a whole series of economic data, and I'm sorry, it's positive, including, I think I see here, third quarter GDP was revised from a gloomy 1% up to 2.2% is well. You've got the Bank of Montreal Combine working for you. How do you filter in the response of Ontario, Quebec, Alberta? How do you, when you see their response to proposed tariffs from 1600 Pennsylvania Avenue, what does that do to America? What does that do to our GDP? And then on to your 4%, 4.0% 10-year yield.
Well, we do know that the Canadian economy is a lot more rate sensitive. And the Bank of Canada has been quite a bit more aggressive on the rate cutting side. So seeing the Canadian economy respond positively isn't that surprising. What I worry about, and I think that most Canadian banks do, is what happens with this looming 25% on the 4th of March. Does that really derail growth in Canada? The short answer would be probably we probably see a material hit, which should translate through to lower rates. And the U.S. probably gets a bit of a downdraft as well. So I think that there's a lot of cross currents brewing in favor of lower yields in the near term.
So what does Bank of Montreal say about Doug Ford of Ontario and what he's going to do in Windsor, Canada to put X tens of thousands of Americans out of work? How does Bank of Montreal see that sequence if we get it?
Well, I think that the short answer is we're all in the position where there are a lot of political uncertainties, and the back and forth between leaders, whether it's coming from Trump, whether it's coming out of China, whether it's coming from Canada or Mexico, will continue to fuel this uncertainty. So
how do you think this, I guess coming back to the U.S. here, we had the real personal spending came in materially weaker than expected there. How does the Fed look at that kind of data?
Well, I think the first thing the Fed would say is the consumer remains on strong footing. Take a look at the longer term trends, and there's no real reason to start worrying about the consumer yet. It's one data point. Yep. I'm looking at that and I'm saying, okay, this is not going in the right direction. If Q1 ends up with a 1% annualized growth rate, that will matter to the Fed, because that is the type of economic slowing in an environment where we might see higher inflation in the medium term or near to medium term. And that's a recipe for stagflation. And that's got to be a concern for the Fed.
On your commute across the nation, good morning to those of you in Canada waking up as well. From the Maritimes out to British Columbia, we say good morning. It's Bloomberg Surveillance with all of our digital efforts on radio, including Apple CarPlay, Android Audio, and the shock of Sirius, how well that's doing for us. Good morning on YouTube. Subscribe to Bloomberg Podcast, humbled by the audience today. Thank you so much for tuning in. Ian Lyngen with us now of BMO Capital Markets.
Ian, we're looking at a 10-year U.S. Treasury right around, 4.25% right here. And I guess you could say it's still kind of within a range we've seen for a while here. But where do you think we end up the year on the U.S. 10-year Treasury?
Well, when the Fed is on hold, like we expect them to be for the next couple quarters, that tends to translate into a range of about 110 basis points for 10s. And so I think that by the end of this year, we'll be back towards the bottom of that range, which puts us at 4% 10-year yields. I think the bigger drama is going to play out in the 2-year sector, and we see 2-year yields at 350 by the end of the year.
I mean, this is where Michael Purvis was at Tallback, and I think he's scheduled next week. He's fly fishing somewhere.
Good for him
right now. But to the point, the short-term paper, the Sweeney yield. I mean, did he just say 350? Is that what I heard?
No, only 4. We'll get down to
4.0. No, on the 2-year yield.
Oh, the 2-year, yeah,
4.05 right now.
Yep.
Equity markets churning here, up 18 right now. The VIX comes in a little bit, a better tape, 20.80 on the VIX. Paul?
Ian, a lot of folks out there, both academics and practitioners, say this Federal Reserve historically has used kind of not bad data, but certainly historically dated data, backward-looking data. And if you looked at the real-time stuff, you could make the call that inflation's already whipped, and maybe they should be even cutting rates here. How do you think about that?
I'm very open to the idea that it's difficult for monetary policymakers to use hard data because there is the lag in data collection, there's the lag in reporting. However, I don't think that the idea that if we look at the real-time data, for example, oil prices for some of the more obvious markets, that the Fed should be basing their monetary policy decisions off of that. Instead, it is those forward-looking indicators. So look at break-evens, look at the survey-based measures, and that's what the Fed is worried about. And I think that that's why the Fed's going to be reluctant to start cutting again.
So on a yield basis, if we get a Lyngen 4.0, just, you're sitting around and having a Labatt's. I mean, Ian, just to cut to the chase, what's it mean for the housing market? Is it like boom recovery, or is the ambiguity that wages are slow, as Neil Dutta talked about, where we don't get a housing recovery?
I think that the housing market is going to struggle. Part of the reason is that the mortgage rate to Treasury spread is still relatively wide for a variety of reasons. And as long as mortgages are high, then translating this through to a stronger housing market is going to be difficult, especially if we see an increase in the unemployment market or the unemployment rate. That's where I start to get really worried about housing.
Great summary. Ian Lyngen, thank you so much with BMO Capital Markets, working in fixed income there. We're going to come back to economics. Francis Donald with us here, really off the shock, as Paul mentioned, of consumption, of personal spending.
That kind of got my attention there, yeah.
Everybody writing this weekend, Paul, I wonder, do we start to see sub 2% statistics?
Yeah.
There's a lot going on here, folks. It's always important to talk to Francis Donald with RBC, the Royal Bank of Canada, on inflation and growth. But based on conversation 1, 2, 3 of this hour, and following on to McKee on the Fed, Francis Donald all of a sudden may be the conversation of the day. Are you going to write for Monday, Francis Donald, of sub 2% real GDP?
I don't think we're there yet, Tom. So our forecast for 2025 was 2%, and that's a bit of an annoying forecast because 2% is sort of the break-even point for a lot of equity models. So a lot of folks are hoping you're going to go sub 2% or above 2%, but 1.9 isn't going to make or break the U.S. economy. And you know what, Tom? I know there's a lot of January data that just landed, but the path of the U.S. economy, there are so many potential outcomes based off of the sequence and size of Washington policy that even if you see downgrades from 2% to 1.8, that's probably not changing your outlook on what's ahead. It's just marginally changing your starting place. So I am more focused on headlines related to tariffs today, a little bit of the upside surprises we've been seeing in Europe and Canada, maybe changing the starting place for the two. Wouldn't get too hung up on a GDP forecast, said from an economist.
I listened to Ed Yardeni, who's been, of course, talking of the roaring 20s here, and he was heated that, yes, there's a lot of noise now and a lot of worry in that. We're pulled back 4% off this great bull market. Francis Donald, what's your vision for the end of the year? Do we once again get a growth recovery as we have the last 2 years?
Well, Tom, we're a big believer that there's two economies at play in the United States. There's the wealthy who are benefiting from non-income gains, that is stock markets, house prices, they're net savers, so they're doing great with those high interest rates. That part of the economy is incredibly resilient, and that part of the economy is absolutely experiencing the roaring 20s and are likely to continue to do so, absent some sort of wealth shock. And then there's an entire segment of America, in fact, the other 90%, that are struggling under the weight of high interest rates, and you're going to see that start to creep into some of this data. They're still responsible for 50% of the economy. This is so critical to 2025 because it's muddying our ability to read so much of the soft data versus the hard data. High-income Americans are going to lift aggregate data probably through to year end, unless they see a wealth shock, of course, and other pockets of the economy are going to look very much like they're in recession. So we are looking at things like consumer credit data. We've actually seen credit card usage as a share of retail sales popping higher. That's higher rates coming into play. And if we don't get rate relief, big segments of the United States, then big parts of the United States will see absolutely sub 2% growth. So for markets, the aggregate matters. For corporations who are thinking about their operating environment, when we talk to our clients, we're saying to them, who is your client group? Because I can't give you one headline number in the United States anymore to explain the entire path of the U.S. economy. We just got to get deeper.
So we got to get Francis Donald on twice.
Yep.
We can have her on now about the booming economy, and you and Alice can have her on at 11 a.m. about the gloom.
Exactly.
That's the way we roll.
So, Francis, can we still kind of refer to the U.S. economy as, one of exceptionalism? Is that still a storyline?
Oh, sure. And you're still going to see U.S. resilience in play probably for several months, at least based on the path that we're seeing now. Now, is that exceptionalism as high as maybe those who had expected it 6 months ago? No, there are some downside surprises. One of them is that the Trump administration, a lot of the enthusiasm economically was that we'd see those corporate tax cuts and that deregulation. But I remember a few months ago talking to the two of you in New York that it's going to matter what the sequence of policies are. And we're not getting a sequence that's really market friendly right now. We're hearing about tariffs and maybe fiscal pullback before we get some of that juicy reflationary type of content. So this is going to be really important heading into 2025.
You got an entire combine. I remember the day Royal Bank of Canada took out Minnesota, Piper Jaffray, I believe it was. And you know, you've done such a great job with a cross-border view at RBC, Francis Donald. What is your summation of the power of Canada with a tariff response, dare I say, tariff retaliation to a quoted 25% statistic? Can Canada get surgical about that to put Americans out of a job to shift the president of the United States?
Well, just a reminder, I'll give you a list, Tom. Canada provides 60% of oil imports to the United States, 90% of electricity imports, 99% of natural gas, 85% of potash, 98% of canola, 34% of your meat, and let's not forget critical minerals, which is 19% of U.S. imports, and 27% of your uranium imports come from Canada. Canada helps to heat the United States, it helps to feed the United States, and this is not 2018 anymore. The U.S. is struggling under an electrical grid and has substantial energy needs that Canada can help to rectify. So I think the focus should be on how much can Canada support U.S. exceptionalism going forward, and what is the upside of actual increased collaboration between the two countries. That's the story that I think will resonate, because President Trump has huge ambition for what the U.S. economy can become, and there is a lot of upside for the U.S. as well. Canada upside equals U.S. upside. We've spent a lot of time thinking that Canada benefits from the United States. The reverse is also true, and we got to push that narrative, not just for Canadians, but for Americans as well.
Is she running for office?
Awesome. Proud Canadian.
Francis, that was wonderful.
Proud Canadian right there. So, hey, Francis, I think I first became sensitive to this K-shaped economy and what it really means and how pronounced it is, maybe in the 2016 election cycle. And now here we are, almost 10 years later, it still seems like it's still a thing. Is this a permanent part of the U.S. economy going forward, do you think?
Oh, yes. And actually, in 2016 and through to 2020, we would talk about the K-shape and the concept that there was actually like haves and have-nots, and that was a structural situation. The problem that we're encountering now, especially in the past 2 years, is that in the past, the haves and the have-nots actually moved more or less the same throughout. So good times were good times for everybody. Bad times were the reverse. The reason there's so much focus from economists like myself and from RBC on the K-shape is that not only do we have this huge inequality, but their economic situations are not moving together, they're moving separately. So in the past, you could look at one group and know more or less how the other ones were moving. That's just not the case anymore. It's broken our models, and it changes how we have to talk to clients about who their end customers are.
Francis, got to leave it there. Thank you so much. Francis Donald with RBC.
You're listening to the Bloomberg Surveillance Podcast. Catch us live weekday afternoons from 7 to 10 a.m. Eastern. Listen on Apple CarPlay and Android Auto with the Bloomberg Business app. Or watch us live on YouTube.
Why don't you drag in here Jordan Rochester, who's, he's rewriting his rewrite for Monday Research here at Mizuho.
Absolutely, Tom. Jordan Rochester. FICC Macro Strategy for our friends over there at Mizuho. Jordan, what's your feeling here about this flooding the zone approach from this White House and maybe some of the policy uncertainty that creates in the marketplace? When you talk to your clients, how do you kind of suggest they deal with that?
Well, from a politics perspective, it's getting things done, which is pretty painful for us in markets, keeping a track of it all. Flooding the zone means you split and divide your opposition. They're not sure which agenda to oppose in that day's media round. But for us in markets, each one has a different investable theme. You've got tariffs hanging over Europe, Mexico, Canada, China like a Damocles sword, with the risk of near-term dollar appreciation. But to be honest, this market is trying to call the bluff of this president and doubting whether these tariffs will go ahead with the numbers he's put forward or at the pace that they've been announced. So this weekend could be a big one. The market still has quite a few people out there thinking it won't happen in the way that he's said, such as the 25%. Then you've got the Doge labor cuts, and that's going to really weigh on NFP prints in the months ahead if you were to listen to the PR campaign from Elon Musk. The actual numbers so far are quite small, a lot smaller than what he would be suggesting. But we are aware that in the next couple of months, if things accelerate from Doge, it could be tricky for the Fed. This market will still probably try to price in rate cuts, not rate hikes, even though we think the Fed's on hold for the rest of the year. And then you've got a deregulation agenda. Surely this is an administration that's good for business, but the tariff policy is kind of conflicting with it. So in answer to your question, he's flooding the zone, many different policies. Each one has a very big impact on markets. Some of them conflict with each other, and it kind of leaves us all scratching our heads.
So I guess from the currency perspective, Jordan, do I just kind of buy the US dollar and just go sit in a corner there and wait?
If it wasn't for tariffs, I'd be telling clients to sell the dollar because there's a great sort of make Europe great again mega, not MAGA theme in Europe. However, the tariffs are a big deal for everyone's terms of trade if they are to happen in the numbers that we're expecting them to see. Imagine if Europe gets a 10% tariff, for example, across the board, reciprocal or not, that would mean a lot for euro valuations. So what we're saying to clients right now is yes, buy the dollar. We think euro could go down to 102, even parity if the number of tariffs is higher than what we expect. And then actually that would be a great opportunity at some stage to take the other side. So it's a down in euro and then up in the second half of this year, because I think the EU will get their act together and respond to this American threat by doing reform, more issuance and fiscal issuance, and we'll see a better investment outlook for Eurozone in the second quarter.
You know, Jordan, I look at the ability to try to, for all of our listeners and viewers, to get a single point terminal view, let's call it December of this year, dare I say into 2026. You have the luxury of Constant Rizzuto and Rochester at Mizuho. Do you guys have a combined view that gets us into next year, or are all bets off?
Well, it's hard to predict what the weather will be tomorrow, Tom, let alone what's going to happen next year. But I imagine what's going to probably happen is we have a lot of the events in politics in the first half of this year. And the second half of this year will be more about the implications for the economy. What do I mean by that? We've got tariffs in the next 1 month or two. I think a reconciliation bill will probably pass through Congress in the second quarter. It might even be April. Joe Biden got his done in March in 2021. So it's very possible that all the politics happens in the first half. The second half will be about the implication of it. And I think that we'll see European growth start to outperform US. This market, Tom, is trying to bring forward that theme. I just think we're not there yet. We need the tariffs to go through first before I can jump on it.
Pound sterling here, Jordan. What's the call here?
I think sterling lower. We're looking for something like 122 during the stage of the next few months. And that's on the back of the tariffs. I also think that there's a domestic weakness story that's creeping up. Last year, the best strategy I had was to tell clients to hold back from doing dovish calls on the Bank of England because we had very sticky inflation. But the budget has changed things dramatically. There's been a tax hike for employers. And what we've seen is a collapse in the employment intentions of firms after that tax hike. It costs everybody across the United Kingdom 1.7% more to employ staff per year from April onwards. So I think what we'll see is in the April numbers that we get in May, quite a substantial weakness in the labour market feeding through to growth. And then by the June meeting, the Bank of England cuts. That's something that's a bit of a non-consensus view because everyone thinks the Bank of England cuts every quarter. I think they accelerate it when they get to June's data round, and that should push sterling lower.
Jordan, right here, what final question? As you await tariffs, and I get that. I have great respect for the idea, wait for the facts. Is there a tradable big figure move in any of the major currencies right now?
I think there is, and I'm at a Japanese bank, and I think Japan is the one. There's a structural change taking place in Japan that's decorrelated it from the rest of the cycle. Now, dollar yen, of course, follows US interest rates, just like everything else.
Yeah.
But if you look at Japanese rates, structurally higher yields is the story, Tom, and I think that's a sharp ratio that's going to be pretty high.
This is really critical then. Do you suggest that the reflation theories, plural, of Japan have succeeded?
I think they're in their infancy, but they're going to succeed. If you look at the labor market, we are seeing some of the largest wage hikes, Tom, since the 1990s. You've got part-time workers getting 6 to 7%. You've got the overall economy at 5%. You've got full-time salaried workers at 3%. These are all numbers above 2%. And we've got the upcoming Shunto negotiations, Tom. We'll get some wind as to what we're going to get out of those numbers. But I think the numbers are going to be another strong 5% like it was last year, or higher. You might have seen the Bloomberg story earlier in the week about steel workers asking for 14%, numbers we've just not heard of before in Japan. So if the Shunto goes well, I think that we're going to see this wage story become self-fulfilling, and Japanese core inflation will be stronger than what the Bank of Japan expects.
I would respectfully suggest, folks, I haven't heard that conversation that we just had with Jordan Rochester in 30 years.
Yeah, I think you're right. I think you're right.
To go like that was fabulous. Jordan Rochester and Mizuho.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
There is a wall. There's any number of walls in Washington, to say the least. There is a CIA memorial wall, of which there are 140 entries. There are 106 named, and there are 34 names on the CIA memorial wall not named. Some do, others talk. We now speak to one of the great doers of the American military, Mick Mulroy. He is godfather to 4 of the kids of those people on the CIA memorial wall. Mick, I'm going to cut to the chase. We just saw the chairman of the Joint Chiefs of Staff shown the door. Can our listeners, can our viewers know that our military is at work in an organized, productive manner on this Friday morning?
So good to be with you all again. I'd say, of course, the president does get to choose who he's going to have as his key advisors, to include the military. But I'd also say, and full disclosure, I know General Brown, that he was an example of meritocracy at work. He was exceptional throughout his career. The facts speak for themselves. You know, fighter pilot, squadron commander, wing commander, deputy at Central Command, in charge of all the Air Force in the Indo-Pacific, and then, of course, chief of staff for the Air Force appointed in the first Trump administration. So highly qualified. If there was issues with DEI, that's a policy issue. Just so everybody knows, the U.S. military, even the highest ranking, don't do policy. They essentially advise and they carry out orders by the civilian leadership of the Pentagon, including, obviously the Secretary of Defense and his staff. So if that was an issue, then that could have been addressed without the need, of course, to remove CQ Brown early. He had much time left on his post. Right. And normally that is not something that changes.
I got to be quick here because Paul wants to get in here. Mick Mulroy, as simple as I can. In the first term, we had Kelly. We had McMaster. You sat at the table with General Mattis. We don't have those people now, do we? This is a new approach to Trump too, isn't it?
Yes. I mean, certainly I think the 3 you mentioned are 3 of the best leaders of our generation, at least from my perspective, especially Secretary Mattis. But this is obviously a different cabinet. It seems to be, you can pick on experience and accomplishment. You can pick on loyalty to the president and political ideology. And I think the latter is really came through in this. And that's, again, the president gets to choose that, but every president gets to choose that. So it's kind of it's an argument that you can make, but essentially so did President Biden, right? So I would say he picked these individuals primarily for their loyalty to him and their political ideology, and that's his choice. But that is a difference, than the first cabinet, which was picked primarily for accomplishment and a long level of experience in the job that they were going into.
Mick, President Zelenskiy, Ukraine, coming to the White House today. Can you give us the latest sense of how you think this situation in Ukraine could play out in the coming days, weeks, and maybe even months?
Sure. This was a big week, right? We had the French president and the UK prime minister, and now we have President Zelensky coming today, and maybe, I think likely, or he wouldn't be here, signing this rare earth mineral agreement. So starting with that, it's essentially ended up being that American companies will get access, whatever that means, to 50% of the minerals in Ukraine, which is substantial. I mean, I've seen reports from reputable groups that it's trillions. Half of it, or more than half of it's under the part of Ukraine that's currently occupied by Russia. So from the Ukrainian perspective, if the U.S. wants access to that, they need to help Ukraine gain their territory back. What's not in here, and what Ukraine really wanted, of course, were security guarantees. That is the biggest thing they need. And ultimately, there probably won't be a ceasefire agreement unless there's some security guarantees, because Russia has violated, specifically when it comes to Ukraine, the agreement not to attack them multiple times, starting in 1994 when they gave up their nuclear weapons, in 2014, after they already annexed Crimea, they agreed not to do it again. They did in 2022. So there should be zero trust on whether they will carry this out unless there's a security guarantee by NATO or European partners or the United States or all the above. If there's not, then it's hard to see how Ukraine would accept a ceasefire that would simply allow Russia to prepare to then attack them again. But we all should hope that's the case. We all should hope that, of course, President Trump and his administration are successful in getting us to a ceasefire that's lasting to stop this horrendous war that Russia started.
Mick, is there any scenario that you can think of where President Putin and President Trump could come up with some type of peace accord that does not include Ukraine at the negotiating table?
No, because ultimately Ukraine has to decide not to fight. I mean, they would be hard pressed to continue the fight, particularly by June, when all of the ammunition we've already provided start running out, without the U.S. support. But they can, especially if Europe really steps up. And they've already proven that they beat the odds, right? Most analysts like myself were predicting 3 weeks and it would have been over. And now we're over 3 years. So don't count them out. But the U.S. needs to continue to support. It's not just altruistic. It is in our own interest. They are depleting the Russian military so substantially that within the last 2 years, they lost more soldiers than we lost during the entirety of a war in Iraq. It is really taxing on them, and it's difficult for them to maintain this. Right. But it will be difficult for Ukraine to keep up that level without the U.S. full support.
Mick, what is the signal to our allies of what we witnessed at the United Nations this week? Back to 1945, we went with Team Russia.
So certainly scared the bejesus out of them, quite frankly. And there's two parts to that, right? So they're very used to their allies being what it has been, for decades, which is the United States and NATO, the most significant military alliance in history. Where I can say that they have fallen short, they being our European allies, that they've essentially left a lot of their security over to the United States. They had the biggest brother on the block, so they were fine with spending their money on things other than their own national defense. They've woken up to that. They are all increasing their expenditures on their own national security beyond what the NATO calls for, which is 2%, some going as 3%, up to potentially even 5%. That's a good thing for them. It's a good thing for NATO. And many presidents, to include President Trump, have been pushing rightfully for them to do that. So that's a good thing. But the problem is they might get to a point where they just don't trust the United States when it comes to our allegiance to NATO. I know Secretary Rubio have said that's not the case. So has National Security Advisor Waltz. I believe that's the case. But that has scared them so much that they are now concerned and potentially even starting an alternative to NATO.
Mick, we got to leave it there. We could talk for hours. With the Lobo Institute, Mick Mulroy, with his service to the nation, with the Marines, and with the CIA.
This is the Bloomberg Surveillance Podcast. Listen live each weekday starting at 7 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.
Take a look at the front pages of the Lisa Mateo report. You're not mentioning Taylor and Travis, are you?
No, we're not.
Okay,
we're not.
Okay.
Definitely staying away from that. What we are talking about is, of course, AI. We always talk about it, but people are finding new ways to use it. That includes cheating on job interviews. So the way they're doing it, they're using these generative AI tools like coding assistants, teleprompter apps that feed them live answers when they're doing video interviews. So Business Insider is saying Amazon, they want to put a stop to it because they're seeing more of it. So they changed their guidelines in their job applications so you can be disqualified if you use any of these things. The question is, how do you know if someone's using it?
Yeah.
So Amazon actually put out some guidelines. So for example, those watching on YouTube, if I'm doing the job interview here, I'm usually looking, and if you ask me a question, I'll be typing. Because you're typing in the question, so what AI will respond. So if you see someone typing, that's a red flag. And then if you see someone, answering your question, but they're kind of like looking like they're reading, like this, if you're on YouTube, that's another red flag. So what they're doing is they're trying to cut back on this because more and more people, and it's not just Amazon is saying it, other companies are saying that people are doing this. They're cheating on these
And they're doing it with the
interviews.
resumes too. There's
With the
certain,
resumes too,
we had a story on Bloomberg yesterday. There's certain keywords that people are focusing on that, you see it on somebody's resume and you can tell that resume was created by a ChatGPT.
Yes.
I'm getting the buzz that for college applications, it's death.
Ooh.
They can tell in a heartbeat.
I'm sure. The college
I don't know
essays,
anything
college
about
essays.
it other than good luck with that.
Yep.
Next, what do you got?
Okay, this was interesting from the
She's
journal.
reading from the screen.
Oh, I know.
You can tell that.
This is interesting. The erosion that's eating away at those homes in Nantucket, so it gets into a deeper look into it. Some of the pictures are amazing if you look at this article. But they say emergency crews, they're scrambling. They basically use these steel beams. They put them under the homes, they jack them up, and they roll them back about a few hundred feet back. But it's happening more often. Since 2023, houses on the street is called Sheep Pond Road. They've been condemned, demolished. Some are moving back, and some they just have to sell for pennies on the dollar. So they're losing out. But here's what the residents are saying, and Paul, this goes to you in the Jersey Shore because Nantucket doesn't have those jetties and those sand replenishment projects like the Jersey Shore. I mean, I remember sitting on the beach in the Jersey Shore and seeing those ships come in, and I was like, what are they doing?
They're out there right now as we speak.
Yeah, and that's what they're doing. But they're saying Nantucket doesn't have that.
They're out in the middle of nowhere where the erosion has been there for years, and I don't pretend to be an expert on it, but I'm looking at right here now on Chester Street in Nantucket. Lee Real Estate has it, and it's a nice little small bungalow on the street, distant from the water. It's like you could shoot a movie in front of it. Are you ready? $3.8 million, and it's 3-bedroom-ish.
Yeah. Well, the problem a lot of those people bought during their pandemic,
4
and now
bedrooms.
their value is going down because they're going to be falling into the water possibly.
$3.8 million.
It's crazy.
For a little.
Tom, if you're going to buy a home on Nantucket or Cape Cod, my personal strategy is you have to also be able to have fractional ownership in a plane. If you can't do that, then don't buy it. Because if you're not flying up there easily, you can't drive it. Yeah. It's a disaster.
Okay. What else do you have?
Last one. This big mistake by Citigroup. It's actually coming to light now. The Financial Times has it. They credited a client's account with $81 trillion. It was meant to send only $280.
Oops.
It happened last April. Never reported because it was like a near miss. But the Financial Times looked into it. It said it was missed by a payments employee, missed by a second official. A third banker finally found it. The payment was reversed several hours later, so that is good news. No funds left the bank. But it just shows that, they're going after this.
As a former bank teller,
it happens.
If I had a $3,000 miss at the end of the day, I could find that in 5 minutes. If I had a $23.87 miss, could never find it, and they would take it out of your paycheck.
81 trillion.
I know. The round numbers you can find easy.
And they took it out of the paycheck. My sister went through this.
Exactly.
Really?
Thank you. The newspapers with Lisa Mateo. Greatly appreciate that.
This is the Bloomberg Surveillance Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 7 to 10 a.m. Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.